Hey, welcome back. It's Nolan Matthias, and some interesting news out of the Financial Post today. The Financial Post is reporting that the Bank of Canada may reduce their lower bound for interest rates below the record-setting 0.25% that they are already at, which could mean another interest rate drop for Canadians. But before we get into the details, do me that favor, hit that subscribe button, hit the notification bell, and please hit that like button for the YouTube algorithm so more people like you can see this video. We appreciate each and every one of you that does that. Okay, so let's get into it. Another interest rate drop. As recently as Monday, I told a group of realtors that this was absolutely something that was highly unlikely to happen, and here we are today finding out that there is the possibility that the lower bound for interest rates could get even lower than 0.25%, which is currently where we are sitting. Now, the Bank of Canada has made it explicitly clear that negative interest rates are not something that they're considering. The reason why they're making that clear is because if they even start contemplating that, it could send a signal to the market that the economy is worse than everyone thinks it is, and ultimately have a self-fulfilling prophecy effect where things get really, really bad really fast. So that's why they're not talking about negative interest rates and being clear that negative interest rates is not something that they're considering, but going a little bit lower than 0.025% absolutely is. Now, typically rates lower than a quarter point are seen as something that can do more harm than good. That's why central banks typically shy away from anything close to a 0% interest rate. And they use things like quantitative easing and buying bonds and things like that in order to help the economy, rather than talk about going below 0.25% to basically a 0% or negative interest rates. It's because they have other tools that don't necessarily signal negative things to the economy that would be very, very, very hard to undo. But the reason why they're willing to consider this right now is because other central banks, including that of Australia, have tested the lower bounds of interest rates and have determined that the harm that is perceived to possibly happen when you go that low isn't necessarily as bad as central bankers once thought. So obviously the Bank of Canada wants to keep this tool in their toolbox, which is why they're talking about it, which is why they're saying that it is possibly something that could happen. Because if it does happen, they don't want it to be something that surprises the economy. Because this happened back in 2013 when quantitative easing programs in the US started to ease and the market wasn't ready for it, and it sent the market into an absolute free fall as a result. So the Bank of Canada, or any central bank for that matter, will typically talk about things well in advance of them considering it, so that the economists and so that the markets know that it's potentially on the table, so that if they go to use it, it isn't deemed as an absolutely catastrophic item of news. Now, to be clear, the fact that this conversation is happening isn't an indication that the economy is getting worse. In fact, the Bank of Canada seems to be very neutral on the economy. They think that things aren't necessarily getting better, but they just definitely don't think that things are getting worse. In fact, they seem to think that when vaccinations start to come around in January, that is going to be a fairly positive sign for the economy. And they're actually talking about future policies in both directions if the economy gets worse or if it gets better. So they're planning for both because honestly, they don't have a crystal ball and they don't know which way this thing is going to go. But what they are being clear about is that they're fairly neutral right now on their stance, which is why you saw them leave interest rates exactly where they were on Wednesday when they did their last central bank meeting. All this conversation about having a lower rate is simply just them playing it safe. And to be even more clear, they definitely haven't changed their position on negative interest rates. In fact, the way they're discussing negative interest rates is that there would have to be another economic crisis on top of the pandemic, over and above the pandemic, for negative interest rates to even be on the table. And as far as increases to interest rates go, long before you see increases to interest rates, what you're going to see is they're going to see them relaxing their quantitative easing program. So what that means is that they're going to start slowing their purchases of bonds long before interest rates rise. Right now, they're purchasing at a rate of $4 billion per week. When the central bank starts to see the economy get better, they'll start to slow that down before they do anything else. And to put that in perspective, previously they had been purchasing far more than $4 billion per week, especially in March, April, May, when they were purchasing large amount of Canadian mortgage-backed securities. One thing is clear, the Bank of Canada and all economists agree on this one fact, is that as long as this pandemic is around, it's going to require extraordinary measures from the Bank of Canada, and the Bank of Canada has committed to be there for Canadians for as long as they need to be. So I feel pretty comfortable with the monetary policy of the Bank of Canada going forward, and obviously the fiscal policy of the Government of Canada. That is one thing that is highly contested depending on what your political views are. But I think with certainty, Tiff Macklem and the group at the Bank of Canada is certainly doing a very, very good job. So if you found this video useful, if you found the information interesting, do me that favor, hit that subscribe button, hit the notification bell, and please hit that like button so more people like you can see this video, and we'll see you on the very next one. Cheers.